Welcome. This is Ralph Bivins from the Ralph Bivins Project, and we're here today in Houston, Texas, the energy capital of the world. We've seen oil prices a year ago, they were zero dollars a barrel, the lowest point ever, and now they're about 70. This is the summer of 2021, and we're coming out of the pandemic too. We've seen a lot of deals, a lot of companies that thrived and survived, and some didn't, and some have done well. So there's a lot of uncertainty in the air, I guess, as we're getting rolling again, and things have changed. So with this uncertainty, we're really lucky to have Mark Taylor with us. Mark is Senior Managing Director of CBRE, the largest commercial real estate firm in the world. And he's Senior Managing Director in the Houston office, and he has a vast amount of experience and knows a ton of stuff. So we're lucky to have Mark. Mark, welcome. How would you? What's the state of affairs in Houston market right now? Where are we? Where are we going? Where are we right now?
Well, thanks, Ralph, and thanks for having me on today. And thanks to you for providing great news in the real estate sector in Houston now for a few decades, I guess, right?
Yeah.
So thanks for having me on. Like most Houstonians, I'm pretty optimistic. I'm very optimistic about Houston's future. In spite of some of the things that we've been through recently, folks like you and I who can go back a few decades, we've been through a few things over, from decade to decade, and we continue to come through them, and we continue to prosper. I'll tell you that just, Texas in general, Houston specifically, I think the one word that's going to solve many problems is just sheer growth. Houston continues to grow. Texas continues to grow. The statistics that we saw really during the decade of the teens were fairly incredible, Ralph. And I know you know a lot of these numbers, but from 2010 to 2020, pre-pandemic, that decade, Houston really led the country in population growth. Overall, about a 20% growth in total over those 10 years. About 115,000 or so people per year, every year, come into Houston. One statistic I like to quote is that, Houston, of course, we know was founded in 1836. And in 1955, we had finally reached 1 million in population. So essentially, it took us 150 years to add the first 1 million people net, and then it's only taken us a little over 7 years to add the last 1 million people. So Houston continues to grow. And a lot of those statistics, again, were pre-pandemic. We're organizing a lot of those post-pandemic statistics, but they continue to be even better. People continue to come to Houston. So overall, that's going to drive a lot of things that we're seeing in the market. Most areas, most sectors of the market are pretty strong. We're going to talk about office. That's probably the weakest link right now, but there's reasons for optimism there as well. So in general, Houston continues to grow. It continues to be very robust. That growth drives opportunities, and it's driving a market that continues to stay fairly strong across the sectors. And we can talk about those sectors in a little bit more detail.
Yeah, I know a lot of people are concerned about the office market. I hate to start at the troubled area, but that there's a lot of concern there. Vacancy, I think we're talking about somewhere in the mid 20% now, the highest it's been in decades. And there's a lot of sublease space on the market. And when companies merge, and like Noble Energy merges, they throw off extra space when they consolidate. Just a lot of stuff like that keeps happening. And so we look at downtown and you go, wow. I don't know, but across the city, there's over 50 million feet vacant. And you're thinking, how long will it take? It's almost impossible to ever fill all these buildings. So what do you think about office right now?
Well, we're facing some headwinds, that's for sure. Clearly, even since 2014, we've had a bit of a slowdown in energy, and we all know about that. And then, the second shoe to drop was really the whole pandemic and the COVID change in the whole dynamic. We have lots of people at CBRE that studies this thing full time, and we've got a group called Workplace Solutions who's really getting inside the head of the clients and some of the biggest global clients in the world. And I can just tell you, if people know what's going to happen really in terms of the way offices are used, they're kidding themselves. I mean, because all those things I think are still to be determined. What we do think is that in general, people, there's a component of the whole idea of the flexible workplace or work from home that will continue. Now, it's not going to be widespread, but on average, even before the pandemic, people worked in the office about 4.2 days per week. Many of the studies show that that'll probably go down by up to a day. So you're going to have people in the office 3.25 to 3.5 days a week, and that's in many cases that's going to create some downward pressure on demand for office space. Anecdotally, we're representing a number of tenants right now in the market, and I'd say flat is the new up because most of those tenants are downsizing. They're either downsizing 20%, in some cases they're downsizing 30%, and so there's going to be continued downward pressure. As you mentioned, as we get to Houston, we're about 23% vacant in direct space right now. If you include sublease space, which is fairly stable, coming down slightly, we're almost 27% total availability. And as you said, Ralph, that's north of 50 million square feet of vacancy. Some of those spaces and some of those buildings will be very difficult to fill. There's just no doubt about that. But what we continue to see is this whole idea of flight to quality that's been discussed a lot. We look at buildings that have been built since 2010, and those have continued to have citywide positive absorption even now. And those buildings built prior to 2010 have had negative absorption. And in net, we've had negative absorption for now 5 or 6 years. So there is continue to be a flight to quality. The nicest and the best managed buildings will continue to win. But when you look at the office market as a whole, there's going to be headwinds. We think until probably another 5 or 6 quarters, it'll probably still stay weak and maybe continue with some negative absorption. We think it'll start to improve in late 2025, early 2026. Hopefully we'll be out of recovery and into a little bit of expansion, but it could take us, 3, 4, maybe even 5 years.
That's taking a lot of patience.
Yeah.
Yeah. Oh man. But that's interesting. So when they say our employees aren't going to work 5 days a week, they're going to work maybe 3.5 days a week, and so therefore they can use less. They go from taking 100,000 to 80,000 square feet of space or something. So that kind of works on down the line. We've got, I think the figure is about 4 million feet of office space under construction right now.
Yeah, and those are pockets. Some are suburban office buildings for specific uses. Some are, essentially build-to-suits. In terms of speculative office space, we're probably not going to overrun the market here. I mean, the buildings that are under construction will continue and obviously get completed. We have built our way into some soft markets. We did that really prior to 2014, 15. That's probably not going to happen now. There's not going to be a lot of spec development. What we have will deliver. And again, most of that I think will do fine because of the flight to quality I talked about. But in its path, it's going to leave oftentimes a bigger vacancy than the space that they will occupy, because people will pay more, but they will also become much, much more efficient in doing so. And we see lots of examples, for example, downtown, where tenants go from 300 and something to 200 and something. They may pay 30 or 40% more in rent their total occupancy costs will probably even be down slightly. But they've got a brand new location. They can recruit, they can retain employees, and all that's part. Real estate is part of a big company strategy. Real estate oftentimes is not a strategy in itself. It supports the bigger strategy of the company. And if the company doesn't have the best employees and they can't keep them, then they're probably not going to be successful. So oftentimes that's where the flight to quality comes in. And again, the newer buildings, the ones that are being developed, the ones that have been developed recently are going to probably do just fine. Some of the buildings that we saw built in the very first of our career in the 80s, which is still a very vast component of the office inventory, is 78 through 84. Some of those are going to struggle, and what you're going to continue to see is significant renovations. So those do stay high quality. Those do compete with the newer buildings, and it's really a bit of an arms race for these older buildings to make sure that they stay relevant. And to do that, it's requiring a ton of capital.
Another sector that I know that you have a group that is pretty active in the hotel market, and of course, and in the pandemic, those guys, that was tough sledding, and the revenue was way down and the occupancy was way down. Some of them had just closed. What's your feel for the recovery in the hotel sector?
It's interesting. Our focus in hotels is primarily in capital markets. It's investment sales, it's debt and equity financing, and also in consulting. Our investment sales team is going to have a record year this year, coming off of last year when, as you mentioned, occupancy was very low. The limited service hotels are coming back very quickly. Matter of fact, if you were traveling last weekend and you didn't get a reservation early when you were on a freeway or interstate, or you flew to another town, it was pretty hard in a limited service hotel to get a room. And so those have come back pretty quickly. Investors are looking ahead, and there's confidence in the capital markets that those are going to be fine, and those are beginning to trade. We also have a fairly large institutional business, and believe it or not, those are beginning to trade as conventions and some of the other things are going to come back. The thing that's going to be interesting, Ralph, is business travel. Business travel is a huge part of the full service hotel business. And man, everybody who's listening and been in the workforce knows that Zoom and other equivalents have just literally taken over in business, and there's going to be some temptation, not to fly to New York and spend $2,000 or $3,000 and have a meeting that's almost as high quality, maybe not quite the same as sitting in a conference room or going to dinner, but the ability to talk to people face to face may have changed a little bit. I'm not ready to predict, and I don't think we as a company are ready to predict in terms of business travel. I think a significant amount of it will come back. We're already starting to see a lot of out-of-town guests who are flying to Houston or coming into our office to meet with us. And so I think it's picking up pretty quickly. It's too early to tell how that's going to impact the fundamentals. But I can tell you limited service hotels are coming back quickly. Full service hotels and conventions will come back. I'm just not sure the pace.
Yeah, well, we'll see about those. I know that the business travel, and there's some deals that people are going to still have to go. They still have to go and have a meeting. They still have to see the client. This is a big transaction, but there are some, that Zoom is going to take away quite a few room nights from a lot of just routine business trips, and that's, we hope that's not too big of a problem.
Yeah, I think you're right.
Let's talk about industrial, which has been kind of the warehouses have been huge. One of the big, they're building so many right now. I think there's over 10 million feet under construction, maybe 14 or 15 under construction, just in the Houston area right now, because of all this activity, the e-commerce that really took off. Amazon is just building new warehouses like crazy because in the pandemic, nobody went to the store, of course. So that whole thing has been really taken off, and um, you would sometimes people would think, oh, we've got too many. They're building too many warehouses, but um, it seems to there seems to be able to lease. But what's going on with the warehouse boom?
Well, industrial is clearly sort of the darling of the sectors right now, and it has been for a little while. I know in Houston, it's really built around growth. So certainly changing patterns and getting closer and closer to the consumer, where regional distribution in Dallas or even Chicago is not good enough anymore. Because we don't want things in 2 days. We want things tomorrow. We want things today. And so much more of our product.
Prime delivery through Amazon, be there tomorrow.
Much more of our product and inventories have to be closer and closer. From a capital markets, there's a huge demand for industrial properties. They view that as a very safe bet, and obviously because of that, they're willing to pay very, very low cap rates, which obviously means they bid the price way up on some of those assets. And we've got industrial buildings, honestly, that are trading more than office buildings, even though the office building costs 3 or 4 more times more to build than the industrial building did. But industrial is going to continue to be the darling. There was a fair amount of concern last year that we were just going to overbuild the market. We've got 20 very capable, high-producing industrial brokers here at Houston. And I don't think a single one believes that there is any supply problem forthcoming. The demand is great enough where those things being built are going to be easily absorbed. The tenants obviously are getting much bigger. 7 or 8 years ago, a 250,000 square foot tenant was a very large tenant. Today it's 1 million plus, and there continues to be multiples of those. The challenge is land. Like everything else, as we grow, it's hard to find land, and it's hard to find industrial land where you can economically build, even though rates continue to go up. There's some math involved, and but what we would consider affordable industrial land, you continue to have to go further and further out, and industrial developers are still willing to pay probably 2 or 3 times more for developable land than they did 10 years ago, where it was you had to have $2 land to develop industrial, and then it's 6, and then it'll approach 8 pretty soon, depending on utilities and other things that are there. So industrial is the darling. It'll continue to I think it'll continue to grow. Houston and Texas will grow. Our demand for goods and services will continue to be, let's just say, short-term to immediate. And as a result of that, there's going to be, for at least a few more years, a fair amount of industrial demand, and lots of people want to own it.
And that land picture is very interesting. You have the industrial land, and I know that your group sought out something down there on the South Beltway, South Sam Houston Toll Road at Hiram Clark. I drove by there recently, and they're scraping it. And there'll be, several 100,000 square feet of warehouse there real soon. But this demand for land, and what you mentioned just a second ago, the developers are willing to go farther and farther out into the suburbs for that. And I think that's also true in what's going on with our residential deal. Guys are home building is so strong. It's so incredibly strong. It was one. Houston is right there at the number 1 or number 2 in terms of housing starts. And you have the millennials coming out of their apartments. They want to buy a home. They like to have a little space around them, and they, maybe the pandemic, they didn't really like getting an elevator every day just to get to their apartment. And maybe they're having families, whatever it is. And of course, mortgage rates are really low, so the home building is super strong. And we keep hearing that developers are looking for land tracts farther out, and of course, you've got the warehouse guys looking farther out for land. So it gives me the feeling that the city of Houston, and this is probably true in a lot of places, is decentralizing big time. We're going farther and farther to more distant suburbs.
It really is. There's, and I don't follow home sales quite as closely, but I read, what you read and others. But there's clearly a residential boom,
Oh, yeah.
both in resales and new housing. It's probably nothing like we've ever seen before.
There is nothing like we ever seen. The builders have waiting lists. They can't build them fast enough,
Yeah, yeah.
And they're building, and they're waiting lists. Sometimes they don't even put a price on it because they're figuring lumber's going up like crazy. All our building, we don't know exactly what the end price is going to be because the material prices are shooting up so fast. We want to be able to sell the house at a profit if possible.
Yeah.
But with that, I think all part of that is the thought that shopping in retail centers and that's in restaurants and whatever, that's also got a lot of potential way out there. Is that your retail people are communicating to you?
Yeah. And obviously, retail will follow housetops. I was even talking to one of our retail professionals this morning, and he said, believe it or not, there's a few areas of town where we needed a new grocer. We need some grocers to enter those markets because the housetops have generated at least enough critical mass to create the demand for some grocery anchored shopping centers, but you need the grocer to do that. On retail, we're still doing fairly well Houston wide. I mean, we're at about 6 or 7% vacancy. If you look at Class A, it's probably closer to 4. We obviously had some turmoil last year. We're working our way through that. We lost some tenants, but we also have a fair amount of tenants who are coming back into the market now. The ones that are probably most active are medical and restaurants in terms of filling up retail space. A lot of that is because many of those are local decision makers or their franchisees who are here. What we really do need though is more of the soft goods and the big box things to begin to move a little faster. And we're actually starting to see the beginnings of that. A lot of that is more centrally located corporate real estate folks who haven't been traveling, and we're starting to see them travel. And so hopefully, whereas the medical and restaurants were local, they can make decisions, they can go out and acquire new spaces. Some of the bigger corporate stuff is starting to become active now. I think there's a target that's about to be broken ground on between on 99 on the Grand Parkway between I-10 and 290. It's about midway. I don't think that's a secret because there's a big sign out. So that's a good sign because they haven't done a new store in a while.
Yeah, a new
and again, that's where the housetops are that you were talking about are continuing to go out that far on the Grand Parkway. And so that's a good sign. And then, there's some other interesting things that we've got some of the banks that are downsizing locations, and that creates some really good opportunities for some fast casual restaurants to go out in the bank location because they can do two things that fast casual really wants today. They want outdoor dining, which oftentimes they can't do in line, and they want drive-in and or drive-through. And so some of these bank branches are going to become really great secondary uses as the banks downsize. That some fast casual restaurants are going to they're going to take those pretty quickly, and we're seeing a bunch of examples of that.
We're talking about freestanding banks that are in
bank
the
branch. Yeah, a retail bank branch, and there's some that are they're different ones are expanding, and some are downsizing and maybe closing 10 or 12 branches in a big market like this. And oftentimes they're fairly well located, but they may be too close to another branch or whatever, and they decide to close a couple of branches. There's going to be demand for that with fast casual restaurants and some other things. On a capital side of retail, it's very active. We had a ton of activity pre-pandemic. Most of that died, and we've got even more activity today. That's both on the private client space. I would say shopping centers $25 million and below, and on the institutional space. We've got a group in each of those spaces. Both of our groups are very, very busy right now. So believe it or not, there's a fair amount of demand to purchase retail shopping centers and even power centers, and pricing is not being impacted as much as you might think. So the underwriting is making some assumptions that either retail, if not recovered in most isolated cases, it will be recovered. They're providing pricing that assumes a fairly robust recovery, and so there's a lot of activity in retail investment sales, and you're going to see a lot of things trade over the second half of this year.
That will be interesting. We look around, and I remember we've had so many things like Palais Royal and Steinmart, these boxes that just disappeared, and I think Bed Bath & Beyond shut down some of their places, and you wonder who's going to come back in and refill those, and we shall see, I guess.
Yeah, we'll see.
Now, in terms of, what about multifamily? Is there demand for that again? I think they're capital markets guys. There weren't many investors buying apartments, buildings last year, and how's that coming back so far in 2021?
On the capital side, it's probably, at least our team is more active than they've been in 6 or 7 years. So I think there's a fair amount of catch up from last year where things slowed down, but we have a ton of deals and deals on the market. There's some off-market transactions that are being negotiated. So there is a significant demand right now to buy retail, and there's also a jumping off spot for a lot of developers who built a few years ago. They probably had to wait an extra year or two to sell. There were some headwinds pre-pandemic in terms of property taxes, and some other things were growing faster than rent increases. And so you weren't getting a NOI or a net income increases as fast as were underwritten, so they had to hold for a little longer. So we've got willing sellers, we've got willing buyers. From a fundamental standpoint, it's reasonably good. 90% is typically the tipping point. We're slightly over 90% occupancy right now. We have delivered more apartments than we've absorbed over the last 5 quarters. I think last year we absorbed 12,000, which is pretty good, but we delivered about 19,000 units. And then this year, first quarter, I think we delivered 4,000 units and absorbed about 1,000. What that doesn't include, though, is there's always apartments that get torn down, and I'm not sure if we are accounting for all that. It's because when we deliver, there's also some that get taken out, but generally, and there's the future deliveries are coming down a little bit. We still see tons and tons of apartments under construction, of course, but I think it's going to be a fairly measured development cycle over the next 3 or 4 years. Financing is going to be a little bit tighter, and it's something that we're going to clearly watch closely. I do think if we can keep the supply in check and we don't overbuild too significantly, then just the growth of Houston, which we talked about at the very beginning, is going to take care of much of the construction that happens. Ideally we stay above 92%, and it'll continue to be a fairly healthy market.
Your thoughts on the energy corridor? That's a famous location that we've just had. That used to be like every major energy company and a lot of small ones, and their companies that deal with design their rigs and things. It was very, very prominent. Some of that's died down somewhat, and Houston is kind of working with this transition on the the nationwide and I guess a worldwide push for this some uh, diminishment of what fossil fuels, I would say, and then transition to other energy sources. What does this mean for the energy corridor, which is huge,
Yeah,
huge?
Ralph, it's tough. That sector, that sub market, traditionally has been the most consistent and the most highly occupied. I mean, it was typically the one sector that was always under 10% vacancy, 5 and 6%. When the market was 15 or 18, the energy corridor was 6 or 8% vacant. Today, unfortunately, it's 32% vacant. Okay, and there's probably some hidden vacancy, inside the 68% that's occupied. It's going to be tough, and it's going to be tough for a while. And you've got obviously lots and lots of big blocks of space that comes through downsizing, really, from 2014, and decisions that continue to, play out over time. As leases get renewed, they take less space. Companies get acquired, space becomes redundant. The sum total of all those things gets us to 32% of that's combined vacancy and sublease space, but it's space that's available to go grab. And there's just big. If you've got 100,000 square foot user, you've got more alternatives than you can imagine. And it's putting pressure on the landlords, obviously, because they need to make these deals. First of all, they need to keep every tenant that they have, almost no matter what. They have to keep the tenants. And if somebody's sitting on hundreds of thousands of square feet of vacant space and a 100,000 square foot tenant comes along, you're going to do whatever you can to make that deal. And so it's highly, highly competitive. There's tons and tons of options, and it's going to take us a while to work through that.
We're talking about potential vacancy in office buildings, and I guess we know that and I guess the 64-story Williams Tower, where Hines, the huge developer, has their headquarters, and they're going to move downtown when they finish their new building. So that's probably, I don't know, 100,000 feet or something. And CBRE, of course, has its headquarters there, and they're really, CBRE has done what they call the 360 workplace.
Mm-hmm.
Introduced everywhere. I think the new San Antonio CBRE office is, adapting what kind of some of the trends about using space that are going to be prominent in the future. But of course that's happening at your office there in the Williams Tower. It used to be Transco Tower, now it's Williams Tower, landmark in the city. What happens to? Have you heard anything about Hines and what that space is? You may not be able to talk about it, but what's going to happen with all that Hines space in the Williams Tower?
Well, we leased this building, and the building went through a fairly significant renovation, which looks terrific. I don't know if you've been through here lately, but during the pandemic and while everybody was at home, a lot of the construction and renovation schedules were accelerated a little bit. It was a little easier when nobody's around. And the building got fully renovated. And, we've been here now for almost 15 years. It's a great location for us, accessibility and everything else. We're getting a fair amount of tour volume. And so, whereas there may be a tenant or two that will leave for whatever reason, Hines certainly has their reasons. Developing a big building downtown is certainly one of them. But there's gonna be demand for buildings like this, and we're fortunate. We've got something really nice to sell with this renovation. As I was talking about, owners have to spend to stay relevant, and this building has maintained very much of a relevance in this market, and even more so now with the new renovations. So we're getting a lot of activity. I'm pretty confident that we're going to have tenants that can replace tenants that leave. But you kind of alluded to, our work. We have what we call free address, as you've alluded to, and I think you'll see more of that as companies begin to deal with, who comes to work every day and who doesn't, depending on how that's being mandated by corporate policy. It doesn't really help you if people only work 3.25 days a week and you still have a full-time desk for them every single day that's reserved for them. And so you'll begin to see, I think, either in whole or in part, where a segment is not assigned desks, which sometimes is hard to it's hard to come to grips with. But once we've done it, it becomes kind of interesting. Every day you pick where you sit, you pick who you sit by, depending on what you're going to do that day. And I can be in an office today because I know I'm going to be talking to you, and tomorrow I can be out there because we're working with a project. I need to interact more closely with some folks. I think you're going to see more and more people do that, which will probably become a little bit more downward pressure on space because you can get less space if you've got some amount of office sharing. But lots and lots of companies are looking at all these things right now. Not a lot of decisions have been made, but they're looking at all alternatives. And again, some of these decisions are going to continue to have a little bit downward pressure on demand. But then, the growth of the economy, the growth of the region, the growth in jobs will more than offset that. And so over time, even though it may take 4 or 5 years, we're going to be back in the expansion mode that we're accustomed to.
Mark, you're fantastic. I really appreciate you, coming on and talking with us today. Hopefully you can come back again sometime, and we'll talk more about Houston and maybe a lot. I know things will have changed a lot. Maybe you come back in 2 weeks and things will change.
Yeah, that's right.
We're on it. But thanks a lot, Mark, and Mark Taylor from CBRE here in Houston, and we're headed for some interesting times. Thank you, Mark.
Thank you, Ralph. It's a pleasure to be here.
Good to have you.